it's time to have a look in the future. And I'll invite on stage Alina Chernakovsky. Then she is from Cushman Workfield. And Alina, she'll give us an image about what it's happened in figures with our industry. Please, Alina.
Thank you. Hello, ladies and gentlemen. Pleasure to be here today. My presentation will be about the hotel investment scene in CEE and SEE. Luckily, I don't need to actually convince you to invest in hotels, because otherwise you wouldn't be here today, right? So my mission is just to give you a bit of background on why it is so. Just a few words about myself. Just a few words about myself. So yeah, Alina Kazikevich, originally from Moldova, so neighboring country and close by heart to Romania, based in Prague for the last 13 years, and working at Cushman & Wakefield, hospitality, CE and SEE team. So yeah, we had a great panelists, and I think my presentation will go in hand on what they're saying with just a bit of illustrations. So just a few color slides to show you. First, let's look at the wider European picture. The blue bars are the office volume transactions from 2013 until forecasted 2024. The gray bars are the hotel volume transactions. And the red line is the proportion between the two. You can see that in the last years, the proportion changed dramatically. Obviously, this is happening because less offices are traded. The offices became less attractive to investors. Yes, people are partially back to the office, but the occupancy is not fully there. The size per tenant is downsizing, so decreasing, and therefore the office is viewed as a risky investment or not as stable investment as it was before. On the other hand, hotel investment is still more or less on the same level, which basically says that there is a capital to be invested from the office assets to the other alternative assets, which obviously will not go only into the hotels, but to the other alternatives as well. But we hope to benefit from this shift. Here we are showing the dynamics in the 2023 and 2024 of the trading volumes. The hotels are the first one on the left. You can see that this asset class registered the lowest increase in trading volumes in 2023, and the expected in 2024 is also the highest. This is due to the resilience of the hotel assets, which was manifested by a strong performance post-COVID, and also by the performance in other sectors. For example, industrial, it's not actually because industrial is not attractive, but because there are less opportunities in this segment, less and less. But the capital still needs to be deployed somewhere, so the hotels are benefiting from that. Now, spotlight on CEE. This is a graph for CEE 6, as we call it, so basically 6 main capitals in Central and Eastern Europe: Warsaw, Prague, Budapest, Bucharest, Sofia, and Bratislava. The graph divides the volumes of transactions in certain periods. So pre-Great Financial Crisis, post-Great Financial Crisis, then the flourishing part of recovery after, then COVID and post-COVID, and the forecast, and the blue one is the forecast for 2024. Obviously, there were a lot of hopes in the flourishing part, and the trend was very optimistic, and then the COVID came. However, the good side of this picture is that the transaction volumes didn't disappear at all. So the gray part in post-COVID is not empty. Many of those transactions were negotiated pre-COVID and basically happened on an ongoing basis, but they were still there. The forecast for 2024 is quite optimistic. It could be that some of the deals forecasted in 2024 will be postponed to 2025. However, this is still a good indication that the market is becoming more active. If we deep dive on the background of the transactions in 2024, we can see that the local capital dominates the market in the CEE. 3/4 of the transactions are financed by local capital in the respective countries. In CE6, like in the main capitals. There is still European capital present, but it views the CE region with the risk aversion due to the political situation. We hope that once in the midterm, hopefully in the midterm, this will change, and therefore the risk premium will decrease and more players will be willing to enter the market. If we look per segment, then majority of the transactions that happened or will happen during this year are in the upper mid-scale, and economy sectors. Luxury has been in the spotlight for a long time, but I think the lack of opportunities, together with the costs associated into converting property into luxury hotel, are creating this decrease in the next few years. But hopefully that will change as well. And maybe in line with what previous panelists were saying, this is an interesting slide. Let me quickly explain what we wanted to depict here. The blue bars are the average transaction volumes for the respective countries or regions. The light blue line is the supply of the rooms, so basically room stock. And what we can see is that the supply in CEE and SEE together combined is the same as in UK, right? It's quite surprising. First of all, it says that there is a lot of room for development. It's just one UK, and CE and SE is a big region. So per capita, per square meter, name it as you wish, but there is a lot of space for development for hotels. Second, if we look at the transaction volumes versus the stock supply, the liquidity in UK is much higher. And there is, a lot of space for improvement for CE. Hotels in UK change hands much more often. There are several reasons behind that. One being is that majority of the hotels in UK, for example, I'm referring to UK as the classical investment market, right? Hotels in UK are mostly leased hotels, which is a very attractive product for institutional investors, pension funds and others, right? In CE, leases are not that common, therefore it limits certain players of entering the market. Second of all, CE is still in accumulation phase. Many investors buy to hold, not to resell in 5 years. Of course, some of them do, but still many do accumulate. It's an emotional investment. It's investment for generations. It's building up companies still. So once we probably transition from this viewing a hotel as an investment, a trophy investment, then we will see much more active market, which will help all the parties participating on it. Yeah, here is just on the left-hand side, the graph depicting the average liquidity, and in CE, it's 3 times less than in UK. So much space for improvement. I started somehow more positively, but now look, it's low liquidity, low volumes. Now everything will be great. On the right-hand side, the lines are showing the movement of yields, so the change of yields from 2007 to 2024. And what we can observe in the last years is the correction in the yields and the difference between Western Europe and rest of the Europe. So before 2022, they went more hand in hand, but right now the region is really, CE region is really viewed as a less stable one. So the gap between the yields in the Western Europe and the Eastern Europe has widened. If we look per city basis, we also see that, for example, the average yield for hotel management contract in London would be around 4.5%. Prague would be around 6.5%, prime locations. We're speaking about prime locations, prime assets. And Bucharest would be probably around 8%. This also creates opportunities for investors who are looking for high returns, because there are no high returns mostly in Western Europe. It's all stabilized. It's core investment, right? Here is a graph of evolution of prime yields in prime locations, hotel management contract in CE6. There was a long period of yield decrease until 2019, and then COVID came. Would we go below that? Probably not. It was probably historical minimum, and there would be always, or long-term, a premium between Western Europe and Eastern Europe. During the COVID, the yield stayed mostly flat because the transactions that happened at that time, as I mentioned, they were negotiated before COVID, so there was not much price correction yet reflected. Then there was a wait-and-see strategy from the majority of the investors. So it's only like in recent last 2 years that we see the yields correction. Obviously, that is also driven by increase in financing costs. As previous panelists were mentioning, if the financing cost is high, you can't expect a lower yield on the transactions. But again, half glass full, it means that the investors who are looking for higher yields, they can come to the region, and the opportunity is here. Back in two graphs about investment sentiment. Back in 2022, we asked investors how do they feel towards investing into hotels compared how they felt in 2019. So did their sentiment change? 42% answered that they would love to deploy more capital into hotels. Around 37% said that they would be on the same page, basically the same amount of the capital, which means 80% of the investors are still thinking that investing in hotels is a good idea. In CE, right? We are speaking about CE, which is good. Now, what about the opportunities they are looking for? So first of all, here the numbers will not add up to 100 because multiple answers were allowed, so don't get scared. We asked them in 2024, what would be the targets for your investment opportunities? And almost everyone answered value-add opportunities. So moderate capex, repositioning, upside from the market potential. Which is fair. I think CE offers a lot of such assets. Two-thirds of investors still would consider something opportunistic or distressed. Opportunistic means larger capex, emerging markets, new developments, and distressed is high discounts versus the market value. Now, I think this is where the buyers and the sellers don't meet, because two-thirds of the buyers are looking for distressed assets, but there are actually not so many distressed assets on the market. And the sellers are doing quite well. The performance is great. Yes, there is still some recovery to be done, especially on the occupancy side versus the pre-COVID period. I think Bucharest is right now at around 90% level of occupancy versus 2019. But the performance is strong, and the ADR held by inflation has sustained a good profitability for the hotels. Therefore, there are no distressed assets, or not so many. So the buyers and the sellers today, they don't yet meet, but I hope that both of them will set a more realistic expectations going forward, and in years to come, we will see much more transactions on a proper market basis. Oh, I was faster than my colleagues. Thank you. Just one more note. Yes. I just wanted to...
Sit down. Thank you very much. Then you see the situation when we are speaking about investment in hospitality, direct in real estate. I repeat once again, it's my obsession. We may have the most beautiful hotels in stone. We may have everything if we don't have people to operate it. And if we have not the best people to do it, this industry cannot survive because it's an industry made by people for people. Then let me now ask to come on stage Professor Joseph Haddad, Associate Dean at THL, to speak a little bit about investment in people, please.
Thank you very much, Ray, for the kind invitation. And let me also express on behalf of EHL and all my colleagues who are joining the sessions today and tomorrow, and our former leaders and colleagues as well, our delight to be supporting this event and to bring even more closer the ties between Switzerland and Romania, as was expressed by the ambassador in his introductory statement. Ray, you mentioned people, and I think this is really an area that I wanted to focus on. I know the session is titled Where to Invest, and I would really argue that a key pillar to success in hospitality investment, bringing investment into profitability and returns, is about investing in people and people development. I probably don't need to convince you that it's all about operational excellence, it's all about guest satisfaction, and this is all linked with having skilled, having motivated, having talent that can be retained and can be grown into their career development path to actually achieve those objectives. And so this is why investing in talent development across the spectrum, from frontline to mid-level management to leaders in hospitality businesses, is so critical these days. And when we talk about investing in talent, we talk obviously bringing skills as regards to developing hardcore hospitality management skills, the technical skills. We talk about bringing soft skills, customer orientation, adapting to changing guest expectations, adapting to new trends. And we also talk about actually grooming the future leaders of the industry. And it is the responsibility, I think, of everyone in this room, owners, brands, operators, educators, to actually foster this environment and this culture, which actually requires investment. In my capacity as Associate Dean for Executive Education, I have seen since COVID a radical change in the, let's say, realization of the significance of this need by the brands with whom we collaborate, by operators, and also by owners. And so we are very keen to actually grow the relationship and build the relationship to that effect. Now, in most markets, and in Romania in particular, and I think, Ray, you mentioned that yesterday, hospitality, attracting talent in hospitality and retaining talent in hospitality is a difficult challenge. And people tend to go abroad, to work abroad. So one of the questions is how to attract and retain locally talent. Now, there are many dimensions to this. Obviously, compensation, obviously, working conditions. But training and offering a career development path is also one that we have seen in many countries, is efficient. And with this in mind, it's about designing, it's about delivering training. There are existing programs by brands and operators which owners can actually work on and align. Enforcing probably in the relationship between owners and brands and operators some KPIs about talent development, maybe also another area to investigate further. And actually designing programs that actually enable the talent at those levels to grow, to adapt to the changes, and to actually bring hospitality to the next level. So, I think everything here, everybody here in this room, I'm sure is fully aware of this. I would just like to say, and so my background is finance. When we look at talent development, it's an investment like any other. So we're investing in physical assets, we're investing in operations, we want profitability, we want return. I think probably one of the levers that needs to be actually looked at more closely is investing in people. Because that's a lever which actually can amplify returns, can mitigate risk of performance. And as somebody once said, investing in people raises value in a compounding way over time. So for those who are actually looking like me at financial parameters, it is actually something very significant. Now, I know that I'm the only thing that holds you between this and coffee, so I won't make that much longer, but I would like to thank you very much, very open with my colleagues to discuss further how we can implement those training, learning, and development programs with a view to ensure the highest level of performance into the hospitality here in Romania and more broadly. Thank you very much.
Thank you very much, but you cannot leave anymore. Please sit down.
Over there.
Another. Then let's reverse a little bit now. You know, hospitality has few stages. And early at the beginning, it was private people who invest. EHL has 140 years because UK, a lot of visitors, they come in Switzerland to discover the ski and everything. And Swiss hotel people are so clever to say, we need a management school. And they create EHL, the first ever EHL school in the world. Because it was a lot of private people investing in hospitality, family and private. And you have a very fragmented industry in Europe because of this. And after United States came with big power in the hotel chain, okay? And hotel chain need much more oxygen. And the fund of investment they came. And when the fund arrive, they start speaking in Excel. Then they have no clue what is a GOP or adjusted GOP, but they know about EBITDA, okay? And the result, if you look today at the hotel chain in the top, there is no one hotelier. They are all from investment, welcome Alina, or from legal side, Mr. von Gunten, okay? The hotelier in the top, they disappear. What's happened now, it's a little bit a reverse because we are coming with new people, developer in real estate, then they are all starting to want to do a little bit hospitality, and now everybody, they realize, well, we have to go back a little bit on the roots. And I want to come back now to Alina to reverse, and what you think about the people, because you present as figures, and it's fantastic, but what about the people behind these figures?
Hospitality without people is not possible, right?
Close. Close. No, it's okay, but close.
Yeah, okay, sorry. So hospitality without people is not possible. That's the heart of the business, right? The figures are there. They should be there. You need to do the business plans, as Frank was mentioning. But if you have no people to actually deliver the service to the guests, the figures will never materialize.
Thank you very much. And Joseph, I want to ask you one thing.
Stefan?
Stefan, sorry. I want to ask you, I want you something tonight. I want to ask you just one question, because everybody wants to go to make a break now. Then the question is very easy. Has people are a cost or an investment?
Well, I think I will actually follow what Alina just said. Hospitality without people, cannot succeed. You need an asset. That's an investment, the physical asset. By the same token, you need people, and that's an investment. So, and I know that, Ray, you mentioned the, let's say, financialization of the industry. I would say let's just start by looking at people as an investment more than cost, because actually there are huge shifting costs with the churn that the industry experiences, with the loss of actually knowledge, experience that is impacting the industry altogether, which can be mitigated by taking a longer-term approach vis-à-vis people. And to the investors in the room, and again, trading with my finance hat on, maybe we start by putting in the Excel sheet a line that is about investing in people, not just seeing people as cost.
Thank you very much. Now I have a last question for you to think in the break. Then how long you'll continue to discuss about the importance of education and dual education without doing nothing? When we take the Switzerland example, then it was the same thing 20 years ago, and now it's the top in everything, in research, in innovation, and the dual education is one of the power of this country. we in this Eastern country, we are discussed a lot. It's very important. It's very important. No, the youngsters, they are going in other countries because they are not well educated on all kind of these ideas. We continue to, it's a nice talking, okay? When you do something, and I'll ask you something, my colleagues from hospitality. How long you'll see what important are our people, but the first thing that you'll cut will be exactly the budget of people. Okay, think about on the break, and we are coming back in 20 minutes. Thank you very much. Thank you. Thank you, Stefan. Thank you, Alina.